Hello, listeners. Welcome to this episode of Cryptonomics. Before we jump into today's discussion, please keep in mind this recording is for general education and is not intended to constitute investment advice. Any opinions expressed are those of the participants and do not necessarily represent those of Witham. Hello, everyone. Welcome to this episode of Cryptonomics brought to you by Witham. I'm your host, Mark Eckerly, and please welcome to today's show our guest, Mike Andrusko, partner at Centri Consulting and the leader of the digital asset and fintech practice. So welcome to today's show, Mike.
Appreciate it. Thanks for having me on, Mark.
Awesome. No, it's good to have you. The one question I always like to start with every guest is, in addition to introductions, obviously you can explain your background better than I could, but tell us about your rabbit hole experience, right? How did you get into crypto and become Centri's digital asset lead at the end of the day?
Yeah, absolutely. Joined Centri about 8 years ago at this point. We're a smaller firm, around 15 people. Started my career at PwC in the audit side, and I call myself a recovering auditor at this point. But yeah, so I jumped over to Centri. Wasn't really sure where to head and where to lead. So after about a year or so, ran into one of our now CRO, kind of going through a couple of different filings of major crypto firms at the time, and walked around the office around 8 p.m. and saw him kind of, waist deep in some of these filings and said, what do we got there? And, after we kind of talked about it for about half an hour, I was like, all right, well, ready to jump down the rabbit hole with you, right? So at the time too, wasn't a ton of guidance. So it was really just figuring out what things are applicable in the real world and kind of using that as the talk track and the education side to make sure that, the crypto firms and guiding them through it at the time, we're understanding kind of the real world aspect of it and how that then applies to the crypto side of things. So that's been something that we've tried to continue doing, as we continue to see, new contracts, new arrangements, things along those lines, what are some of the more traditional guidance that applies to kind of make a little bit more sense of it. But always great to see that as we kind of continue through this, that, we're starting to see more crypto specific guidance come out that, makes it a little bit more easy to apply instead of kind of going through 3 or 4, hey, this is akin to this or that kind of steps.
Yeah, we had some tax guidance early on when it comes to digital assets back in 2014, 2015. But I think, and what we're going to dive into today on the accounting and I don't want to say audit side because it's more so just accounting side is how to account and treat digital assets, right? And I think getting more in line with where investors are thinking, with where the space is thinking. But being that Centri was one of the early movers in the space, right? 9 years ago, like you mentioned, there weren't many service providers working with digital assets at all. So it was few and far between. So having that legacy knowledge and seeing all the various transactions and complex agreements, like you mentioned, trying to fit a lot of what crypto is trying to do into the existing accounting literature was, I'm sure, a fun exercise. Can you tell us just a little bit about like Centri as a whole, just like what you got and where you fit into the space?
Yeah, absolutely. So Centri more broadly is a accounting advisory firm, bunch of CPAs working on the non-attestation side of things. So no audit, no tax compliance, really helping out the mid-market and helping out emerging growth companies traditionally from a IPO, SEC, capital markets side of things, right? So kind of helping them go from, quote unquote shoebox to audit, right? So kind of getting them through that process and shepherding through that process. That's kind of led us to have a pretty nice niche between kind of management and auditors to kind of help coach through that process, be that liaison. And really, as audit firms come in and maybe see that things are not quite where they need to be for them to do their job, we're to be that cleanup crew, right? Come in, help with the accounting policies, help with the reconciliations, help with the technical accounting memos, financial reporting, whether that's for, current SEC filings or for IPOs and transactions, really to be that resource. And then we really just kind of saw that and applied it to the fintech digital asset side of things, right? So what we were seeing is, a lot of co-founders that were really intent and understanding of where they wanted to lead their company, but may not necessarily have that accounting background. So we even, so much to say was we pulled them in as maybe the outsourced accounting role to start as they kind of build up their revenue stream and their contracts. And as they continue to grow, go through the month-end close, board reporting, get the financial reporting from a private company standpoint. Then as they make that jump to the IPO or, reverse merger or SPAC side of things, helping them through that IPO process and getting the financial reporting ready as well. So kind of took that historical SEC reporting knowledge from the traditional market standpoint and then applied it to the fintech crypto side of things.
Yeah. And coming with all that legacy knowledge with understanding US GAAP, a lot of the technical areas when it comes to where you're assisting clients, and then just like you said, parlaying that into the digital asset space, which are seeing funky stuff pop up all the time. So understanding, let's dive into the new standard. Well, I shouldn't say new anymore, right? I think it's been out for almost a year and a half or so. But what we're seeing here at Witham, and I'm sure you guys are seeing, are now that there's a full year under a lot of companies' belt, particularly on the public company side, that they've adopted back in Q1 of 24, had their 10Ks issued now, or soon to be issued. Here we are at late March. And kind of following that fact pattern and the disclosure point of view, let's start with what is the fair value standard, right? So ASU 2023-08 came out in December 2024, and it was long-awaited guidance that we've, as industry, working with an industry, have been waiting for. But why don't you give us a little 101 on what this new ASU is and how it relates to a lot of digital asset companies?
Of course. Yeah, so really what it meant to do was take what was the intangible asset guidance that was being applied to digital assets in the past and kind of transition a little bit from that cost versus impairment treatment to fair value, right? So really what was happening in the past is, if you bought any sort of digital assets, you're holding them on your balance sheet at that initial cost basis. And as we know, it's a very volatile market. As you were going through periods of declining prices, you're taking a look at that. And if you're transacting or finding other impairment indicators per your accounting policy, you're writing down that value of that asset on your balance sheet. And it's running through impairment expense. And then as you kind of continue to report on a go forward, you're stuck at that impaired value until you sell that asset and recover it. And then you might have a realized gain or loss. And really what was happening with that was that you now had this depressed priced asset on your balance sheet. And say the market goes back up, which it invariably will, you're not able to recognize that uptick in value on your balance sheet. So it's going to be depressed to impairment. And then, when you report that to your bank, your board, your investors on your, SEC filings, it has a non-true value on that balance sheet because it's stuck at that impaired value. So if an investor's looking at that and the price of Bitcoin has doubled since then, they're not going to see that on your balance sheet. It's not going to be reflected on your balance sheet. And a lot of people had a problem with that, as they rightfully should. So really what this guidance is meant to do is make the value of the digital assets, it's still kind of running through intangible asset guidance, but it's got more of a subsection for the digital asset fair value side of things. So now what you're able to do is essentially go through, take a look at each of your assets. And again, this is not going to apply across the board, right? There's still some things that from a GAAP standpoint are not going to be applicable to the fair value guidance. It still has to make sure it touches upon intangible asset guidance for the codification. It can't have any sort of enforceable rights, right? So a lot of the times when you see wrap tokens or some other DeFi assets, they could be scoped out of this from that enforceable rights standpoint. And then really it's also if companies are creating their own token, typically wouldn't be applicable to fair value, right? If they're minting their own or they're getting tokens that are issued by a related party and want to make sure that it's, fungible as well, right? So that's where kind of NFTs kind of get scoped out of this guidance for the most part. And a lot of stable coins as well, right? If they meet the definition of financial instrument, so your Tether, your USDC, typically get scoped out. But for the most part, right, they're going to be pegged to a dollar. There's really not a ton of fair value volatility there. And really what you're then doing is taking those assets that are now, step one is the scoping, right? So once they're in or out of scope, the ones that are out of scope will continue to go through kind of that costless impairment unless there's another applicable guidance applicable to it. And then what you're then going to do is for each of those assets, we're going to take a look and say, all right, what's the principal market for each of those? How do we determine, A, what do we have access to? B, what are some of the volumes of the most popular exchanges for that particular asset? And how often are we trading on it, right? So say you're an American company, you're not necessarily going to be relying on, exchanges that are outside the United States, right? Because you're not necessarily either going to have access to them. And a lot of the times, their volume may not necessarily be as high as the ones that are more domestically available that are applicable. So then you're able to kind of take a look at those assets, take that fair value based on the principal market, and now you're going to do like any traditional investment or fair value asset. You're going to market to market on a quarterly, annual basis, depending if you're, SEC filer, you'll do quarterly. And if you are maybe a private company, you'll go more on the annual side of things. But essentially now you're able to properly reflect the true value of that asset at that given point in time, at quarter end, period end, based on that scoping, understanding, and then going through that fair value guidance from a principal market standpoint. So really it's meant to kind of, now when you're comparing the two, say the price went up after it went down, you now have that appreciated value on your balance sheet versus in the past it was sitting still at cost less impairment.
And that's what I was just going to say. I think from the reader's perspective, right, reading financials when they're ultimately issued a couple months after the reporting period, at least it's going to show a better financial position of where the balance sheet is, where the company is from a cash or cash-like instrument, right? If they're going to use Bitcoin to pay vendors or whatever it might be, or investments, but you're not really driving down that value, which wasn't indicative of a lot of companies. I mean, of their what they can do with their investments. Because I still have some companies now that they've adopted the new standard, but we're holding Bitcoin at sub $1,000 per token, and it was just because it's been impaired so low for such a long period of time. Obviously, the balance sheet didn't show anywhere close to what the company's position was. But going through that analysis, the legacy accounting of cost less impairment, can you tell us some of those challenges that you experienced working with companies and kind of going through a lot of that minutia, sifting through all that legacy to find the lowest possible cost? Because I believe it was an SEC comment letter that came out, was it this time a year ago or the year before, where we finally got a little clarity of what that low price should be, the lowest possible intraday value. Because I think a lot of companies were just using a close price or whatever was readily available that they could obtain. So getting that clarity helped. But going through that analysis from an accounting standpoint was a nightmare.
Yeah, so it was definitely good. And again, everyone was kind of trying to do their best with the information they had, right? So it's always good to see, what the SEC is thinking from a comment letter standpoint to get a little bit more clarity, for better or worse, right? So in the past, just like any other intangible asset, you're going to take a look and see, what are my impairment indicators, and what are the events that may cause us to believe that we had an impairment. And it varied company to company in what that process was, right? It was really more akin to an accounting policy election at the time until some more concrete guidance was put out, right? So a lot of companies typically would look at, hey, what did we buy and sell at during a particular period for that to be kind of your impairment indicator. And honestly, when we were going through that with a handful of companies, that kind of made it easier because you were able to just kind of highlight all your transactions and let's look at them and see during that period, what does that look like? What kind of came out of the comment letter standpoint was more so, I think they ended up saying, it's got to be daily, where in the past you can kind of take a look, maybe it's weekly, maybe we were doing monthly, maybe we were doing quarterly. Really depended on kind of what the company wanted to do and how much time they were looking to spend on it. From that comment letter, it was very clear that, hey, it needs to be daily, which, for a lot of companies at the time is a very big lift. And it was not only daily and the prices you were transacting on, it was, hey, it's your principal market. If it dipped at any point below your cost basis, that is now an indication of impairment, which honestly, that, wasn't necessarily the way that a lot of us would agree with, especially in a market where flash crash is in the nomenclature. So I think, again, gave us some guidance. I think it was more so a effort with your auditor as well. What are we comfortable with, right? Are we making the right effort here? Are we having the right accounting policy with that in mind of what's kind of been the comment letter before? So, I mean, again, it ends up being a little bit more of a policy election on some pieces, but there's definitely a difference between looking at something on an annual basis and just at what you're transacting at versus daily and, hey, my principal market's Coinbase and price of XYZ dipped to, a penny today. Now I got to impair everything and kind of stuck there until I sell it, which that's kind of the other piece of it is a lot of these companies, especially now when you're seeing some of the non-crypto related companies that are buying it as a treasury asset, their plan is to buy and hold, right? So if we were still sitting in an impairment guidance standpoint, that's not going to look great and kind of defeat the purpose for them holding that treasury asset for their shareholders, right? It doesn't translate that value to the balance sheet, doesn't translate that value to their shareholders either.
Agreed. And I think that's where this standard helped paint the better picture for companies and their financials and try to make it almost like a business case for where you're holding this more as an asset. Because a lot of companies that we were working with before were using it for that purpose. It just wasn't indicative on the financials. So we talked about what's in scope, what's out of scope. But when you're thinking of adopting this new standard, what does that look like from an accounting standpoint? So can you talk us through almost like, I don't want to go to journal entry 101s and T accounts, but
right.
How would that be reflective on date of adoption? And when public versus private companies should they be adopting this standard, right? Because I had one company that tried to adopt, it's like Q2 or Q3. So can you tell us a little bit about that?
Yeah, of course. Yeah, so I would say from a adoption standpoint, right? So first you're going to see when do I want to adopt, right? So for public companies, I believe it was any time after, or the years ending after or starting after December 3rd or 15th 2024, right? So typically it would be around 1/1/25 would be your date of adoption. But again, able to early adopt as well. So, and private companies, it's kind of whenever you want to kind of get in there similarly. So
Yeah.
really what you're doing first is what is my date of adoption, right? So an example we have of a client right now is they're going through and contemplating a first time audit, and 2024 is going to be presented as kind of the most recent financial statements. Well, if they're doing comparative periods, then you're also going to have 2023. So now the question becomes, do I adopt as of 1/1/24 and maybe have a mismatch in kind of how it's presented on the two financials that are comparative in my financials for the filing? Or do I go all the way back to the beginning of 2023 and kind of start looking at it from there? In this particular case, they wanted to go back. So we'll take a look first at what are the holdings as of 12/31/22. And we'll start there and kind of go through that scoping exercise, right? What's in scope, what's out of scope, and kind of go through that process. And then for anything that's in scope, we need to see what's remaining at 12/31/22 in this particular case, and how much impairment has been recorded for those assets. And step one is to essentially reverse that impairment for all of them so they're back to cost and running that through opening retained.
Mhm.
Then what we're going to do is go through that principal market assessment, right? So now all those assets that are in scope, they're now back to cost. As I'm looking at it on 1/1/23, what's my fair value, right? So as I go through each of those principal markets, hopefully you're writing all of these up and you're going to now reflect it at the higher fair value as of 1/1/23. And that kind of gets you to kind of your initial adoption. And then from there, you're essentially treating it like any mark-to-market asset on a go-forward basis as you kind of flow through the principal markets going forward. So you're going to see, if I do a quarterly filing, what's my 3/31 fair value? What's my 3/31 quantity of each of those in-scope assets? You'll also take a look and typically have to reassess principal market to make sure that still makes sense. Hopefully the exchange isn't defunct. Hopefully nothing else has come through. You're kind of business as usual there. And then you'll market to market again. That's all going to run through unrealized, which really wasn't a thing when you had the impairment side of things. And then as you continue, that's really kind of the process, right? Mark to market, see if they're all still in scope. What's my principal market? Move on from there. And then finally from there, that's on the accounting side. Not to jump ahead, I'm sure you're going to ask this question later, but while we're already talking about it, you have the disclosure updates, right? So now you're going to take a look and see, all right, what are my assets? I want to see the listing of assets, my quantity, my cost basis, and then my fair value. So that'll be kind of more of your inventory of assets. And then you're also going to take a look at and want to document and disclose what does that look like from a roll forward standpoint, right? And it's not just I had acquisitions and disposals or inflows and outflows. It's, what kinds of inflows and outflows did I have? Was it mining activity? Was it staking? Was it through debt vehicles? Was I selling merchandise and collecting, crypto on it? Kind of getting to that level of granularity to understand from a dollar value standpoint. And depending on, how granular you want to be, you could do it at the asset level. You could do it in aggregate. But essentially going through that roll forward process that you'll see for a lot more of those intangible assets as well.
What have you seen for all of that work with the adoption of this new standard? What have you seen as some of the pain points for companies adopting this?
Yep.
Has it been getting that data from your principal market? Has it been going back to the original cost base and reverting some of that impairment piece? What have you seen as some of the challenges that maybe some other companies need to know to get out in front of?
Yeah, it's definitely been a wide variety. It's even going back to the beginning. I mean, unless they're using a subledger that supports all of their assets, it's really going back to the blockchain. I mean, there's some blockchain explorers that just don't have that export feature, or it's not at that level that's very easy to pull it out of, especially in companies that have high volume. So step one is really just kind of getting all that blockchain data and putting it in some sort of consumable form, whether it's going through a subledger or you have some sort of Excel analysis that you're going through. But from the adoption standpoint, I mean, you hit it right on the head, right? It's kind of making sure that we're understanding what is that remaining cost basis and what is that remaining impairment on that remaining cost basis asset, right? So that's kind of I might be able to see all of the 2022 impairment for the period. Some of that might have gotten sold, right? So if I see, $10 million of impairment in a given year, I'm not looking at that to reverse it. I need to understand what's left that needs to be reversed for the assets that are sitting on their books as of the end of the year. So that's always a pain point there. Going through, I'd say, the principal market assessment, just from a first time standpoint, is always a challenge, just because it's a different process. Going through and pulling that volume to make sure you have that comparative nature of that information, to make sure that you're going through that for your auditors or for your investors or whomever, tends to be a challenge as well. And then from there, once you kind of have those two pieces, it's a little bit rinse and repeat. But I'd say for companies that may not necessarily track it at that granular of a level, getting it to that point from the first time through is always a challenge.
Yeah, and I think it's important. I'm sure you've advised clients with a similar approach. I'd be curious if you have something different about the setting up the account structure for this new adoption, right? It's important to maintain your cost basis per asset for tax purposes. You want to make sure that you're bifurcating out the two for accounting or audit, as well as for tax, so your returns are accurate. And then when you have a sale, you know which tranche to properly allocate it to. But what I've told a couple companies is when you're booking this unrealized markup, almost create a separate asset and corresponding P&L account just for the credit where you're flushing through those quarterly or annual mark-to-market adjustments. So you have a core asset at cost, and then you have another account with your mark-to-market adjustment, just so you can always tell the difference between the two.
Yeah, I mean, I would say for the most part, as granular as you can get is about probably best. Understanding that it's tough to maybe track and set up all of those accounts. Really, at the end of the day, we always look at it is if your auditor comes knocking and wants that support, how easy is it to pull together, right? You want to make sure, if I have, Bitcoin and ETH and Litecoin, much easier to see that and kind of pull that out because I've already been booking it on an individual basis versus having that extra exercise of kind of going through and saying, all right, well, now I got to come through all of this and kind of pull it out and kind of have that reconciliation on the back end. So it really just depends on what the lift you're looking to have. I mean, if you're going through audit, more granular, I'm sure you'll tell your clients more granular and specific is always better. But I mean, we've seen it both ways, but we always kind of, recommend, get more granular. It's going to make it easier in the long run.
Yeah. Okay. So I think we've beat up this new standard pretty well today. There's a lot to unpack, but I think you've done a great job explaining this. The last question I have is, in terms of disclosures, this is probably just me being a financial statement nerd over here. When you think of these, with the adoption of this new standard as a quote unquote investment now, right? I know it's still under the intangible guidelines. You have to add a fair value hierarchy chart to the footnotes. And the reason I ask is because you're going to see a lot of these assets that have some thinly traded volumes and then some that are widely traded. So you have Bitcoin, Ether, Ripple, called the blue chips, right, if you will. And then some that maybe are more esoteric, that don't have as much of an established market. Where would those fall in line between like the level 1, 2, and 3 hierarchy chart? Because you went through the analysis of the new footnote disclosures, right? What you need to include. Is this also in that space? Is that also required disclosure?
Yeah. We've definitely started seeing companies have a line now in that fair value table of digital assets, of stable coins, and kind of footnoting it a little bit in there as well, right? So to your point, it really is just kind of going through that level 1, level 2, level 3, and seeing what are you relying on, right? Are you able to see it on a exchange that has decent volume to kind of argue that level 1, level 2, or is it something that isn't quite readily exchangeable yet? Maybe you got in on a pre-sale. Maybe it's an ICO. That probably would sit more in that level 3 side of things, right? And then as you kind of go through that and have the level 3 side, make sure you have that roll forward, your ins and outs and the changes for that piece of it. But 100%, you nailed it on the head. That's definitely going to be a part of that FMV table. Even though it's not necessarily financial instruments, it's got that fair value side of it. And we see, a separate line on that for a lot of our clients for digital assets.
Awesome. So my final question for you. There's a lot happening so far the first quarter of this year. The pro-crypto administration that's now in the White House. What are you most excited for in 2025? Some of the changes that have come out already. I think we're seeing a lot of movement. I think there's a lot of momentum in this space. But I'm curious, what are you most excited for that has either already come out or could potentially be in the pipeline for the remaining 9 months?
Yeah, I mean, I think it's definitely great to see an administration that's a little bit more pro-crypto than we've seen in the past. I think over the past couple of years, you've seen companies leave the U.S. because of the stringency of the regulation and kind of just not wanting to have to go through the hoops that were there. I feel like we're starting to hear conversations about people coming back now, right? So I'm definitely interested and excited to see that, I'll call it redomestication of some of these companies. And hopefully we'll see some, foreign private issuers kind of making the play to come into the U.S. as well. And I'll tell you, I've probably heard IPO from crypto companies more in the past couple of months, past couple of weeks than I have in the past 18 months, right? So I can tell you right now, we're working on a couple of projects that are heading in that direction that are looking a little further out, which is great to see the patience and the maturity there. But yeah, no, from a company that loves to help companies go, through the IPO process, that's definitely what we're most excited about, is seeing a lot more of that redomestication.
Yep. Yeah, I completely agree. And I'd be curious to see if we're going to see a big movement, particularly with what's happened on the meme coins in the last couple months, and a lot of that being minting and driven in the United States. If we're going to see token issuers come to the United States, because I think for a while now we saw a lot of the offshore foundations set up, the labs here in the United States, and that arm. And I mean, going back 5-6 years, a lot of the entities set up in like BVI or
Yep.
somewhere offshore to do the ICO proceeds. So I'm curious if a lot of that comes back here now or not. So a lot of things to be excited for.
Absolutely. No, it's exciting times for sure.
Awesome. Mike, I appreciate you joining us. That wraps up today's episode. Where can listeners go to learn more about you, your LinkedIn? Where can they find Centri?
Yep. Yeah, absolutely. So yeah, on LinkedIn, we have centriconsulting.com as well. You can kind of find our fintech digital asset pages. Yeah, also have a capital conference coming up in about a month, based on the time that this is being recorded. So looking to get people in front of some investors as well. Emerging tech, life sciences. We'll definitely have a blockchain track as well.
Awesome. I appreciate you joining us, Mike. Thank you.
Of course. Thank you, Mark.
All views expressed in this podcast by Mark Eckerly or his guests are solely their opinions and do not reflect the opinion of Witham. This podcast is for informational purposes only.